When you sit across from somebody that has accumulated lots of wealth, 10, 15, 20, $100 million, you want to know how they got there. And I learned eventually they all did it one of three ways. People built, owned, and monetized a business. A lot of them did it with real estate. And the third was they had inherited it. How do you help people actually create wealth? Whereas most of the industry is designed to find people with wealth and management on their behalf. Most people would rather talk about, drugs and religion and whatever else before they'll talk about their money, right? And so, people don't want to talk about, it's a very sensitive thing more than most things to people, and it's very vulnerable.
Yeah.
And I think a lot of people don't go get advice because of that.
Welcome back to Homeschool, where we talk all things home buying.
And more.
My name's Carlton Puckett.
And I am Mary D. Bryant.
And we have with us today Mr. Ryan Ponsford. How you doing today, Ryan?
I am not too shabby. How about yourselves?
Fantastic.
Doing good. We're excited to have you.
Thank you.
This is a fantastic topic, and we're excited to discuss what you do. Tell us what you do.
Well, that's a valid question. It's a very curious question for a lot of people. So my background's been in financial services, a little over 20 years, maybe 25. I guess you lose count after a while and get gray hairs in the process. But I've been working with families for a very long time. Historically, I started out in banking, which is a whole nother interesting story. That happened, which I don't know if we want to go into that, but I thought I was going to be a doctor, ended up in finance, and have a degree in psychology. So you break that down, creates all kind of things. And on that point, what actually is sort of interesting when you look at money and finance, I would almost argue a lot of it is almost as much or more psychology often than it is math and finance, which is what a lot of people think it is. And especially when you're advising other people, so much around money decisions become behavioral decisions as much or more than they do financial decisions. So it's sort of a fascinating background to have, and it's really worked well for me in all the years I've been doing this.
So you mentioned financial services. So specifically, you are a financial planner, as maybe might be just a plain term or a simple term.
So that can mean a lot of things, right? So we'll go old school education here.
Yeah,
so
what does that
technically,
mean?
Please.
A financial planner is a term reserved for people that have a CFP designation. So you actually have to have a CFP to be a financial planner, which is why you hear financial advisor, financial consultant, wealth manager, all these other terms, some of which mean things, some of which are more for marketing, but it can get pretty darn confusing for people.
Absolutely.
And so there's a lot of different types of planning businesses and a lot of ways to build a financial firm. So my personal background began more from a planning perspective, right? So in banking, it was a lot of credit. So we did a lot of work in credit, and then also worked with asset management. So how do you manage money for people?
Yeah.
Most of my time in banking was in the private bank, which is essentially a little bank within a bank that works with the bank's most affluent families. And I'll share a little interesting thing that I learned, and I think will apply to a lot of the audience here, which is when you sit across from somebody that has accumulated lots of wealth, right? 10, 15, 20, $100 million, and you're a young kid, you want to know how they got there, right? How do you create that type of wealth? And so I was consistently asking those questions of these clients and families we were serving, and I learned eventually they all did it one of three ways. You want to know what they are?
Yes,
okay.
please.
Yeah, we're dying to know.
Okay, good. So there's one of three ways. So, we all think you work hard and save money. But the reality is the three ways that I observed is people built, owned, and monetized a business. Okay. A lot of them did it with real estate, especially if you're in California. Real estate was a wealth accumulation tool. And the third was they had inherited it. Okay, those are the main three things that I saw. A few exceptions, but not many. And so then I looked around at the financial institution and I realized we were in theory the most qualified advisors working with the most qualified clients. Yet we did very little to help them build, grow, monetize businesses. We did very little to help them accumulate wealth with real estate, which I think is one of the large gaps in the financial services space.
Right.
And the sad thing on inheriting money is mostly what I observed is money transfers to kids blow the money and end up hating each other.
Sounds about right.
Which is even worse, right? And so over the years, I set out to try and solve those three things. How do you help people actually create wealth? Whereas most of the industry is designed to find people with wealth and management on their behalf. You take over the management of their wealth they've already created, diversify it for risk, as opposed to wealth creation, which is really a much different topic and conversation than wealth management.
Well, let me ask this. What makes a good financial planner? I mean, versus a bad one or what have you. I think this is something that people coming straight out of college would want to know, because I know myself coming out of college had absolutely no clue. I thought you just save a ton of money and buy what you want, and that's just about it.
Yep. So there's a wide range of what a financial advisor may do. And so it can go from as simple as a product distribution. So if you look at the origin of financial services, and this is going to really freak some people out, maybe even offend some people in the space, but I'm from there, so I'm allowed to, right? So the origin were financial institutions are product manufacturing companies. They manufacture products. Insurance companies manufacture products. Mutual funds is a product that gets manufactured, and financial advisors were historically a distribution channel of those products. It's essentially a sales team to distribute product. And financial institutions make money on the sale of those products. So a lot of it originated that way. Over the years, the industry has evolved into where it's become more client-centric. And so it became more around planning. How do I actually help people make good financial decisions? How do I help them evaluate how to save, where to save their money, the tax implications of that, buying homes, selling homes, timing on all those things? Do I need insurance? Do I not need insurance? And it became more of a, people would call it more of a holistic approach to where the client is actually the person you're serving as opposed to an institution and its sales.
So there's not really,
even more.
So there's not really a specific age that you can start with. So meaning you can come right out of college or right out of high school and start saving in some way, or have a financial advisor that would direct you on what the easiest way would be to start something.
The challenge, so here's the pros and cons. The challenge with the advisory industry is they have to make money, right? They're in business, so they need to make money.
Right.
And the more wealth you have, the more profitable you are to a financial advisor. And then it comes down to how they all get paid, right? So you really need to look at the compensation model for an advisor to understand if they're a fit for where you are in life. Okay, so here's an interesting reality for a lot of people is when you are in college, if you're like me, you're pretty broke, right? You're scraping by, you're paying rent, you're probably working some little side job, you're doing whatever you can. Nowadays, there's side gigs and side hustles, and I don't know whatever people do, but I see a lot of kids on a beach with laptops making probably more money than me, which is awesome for them, but they didn't have that when I was a kid. The internet had just come out, right, as a new thing. But so you're broke, and then you graduate and you maybe get a real job. And all of a sudden you go from making no money to having legitimate income. And you might have, if you do nothing, an extra couple of $1,000 a month that you didn't otherwise have.
Right.
Well, here's the scary reality. Expenditures will always rise to meet income. Expenditures always rise to meet income in the absence of some type of effort. Okay, so when you get that first job, most people don't know what a 401k is.
True.
They don't know how to invest in it. They don't know how much of their money to allocate. They probably have a choice between a traditional 401k or a Roth 401k. They don't know the difference. There's nobody to help them understand that. There's online tools that you can use, but a lot of people, one of the great challenges in financial literacy in my observations, people want to know finance. They don't want to learn finance.
True.
Right? Everybody wants an injection with the answers.
Sure.
Nobody wants to go through the process of learning it. And that's one of the great challenges.
Now, with that being the case, you're always going to run into people when you have to open up the books and basically show somebody your finances. It's an extremely vulnerable point in your life. And you are very, very scared that this person is going to take your money. So let me ask the question, what makes a bad financial planner? What exactly, who's the person we want to run from versus a person we want to run to?
Yeah, really, it's one of the red flags, right? Because it's hard to know. And to your point, is most people would rather talk about, drugs and religion and whatever else before they'll talk about their money, right? And so, people don't want to talk about, it's a very sensitive thing more than most things to people. So you're 100% right. And it's very vulnerable.
Yeah.
And I think a lot of people don't go get advice because of that. So, how do you read into that? Now, there are advisors that are good, advisors that are bad. Of course, every industry has that. Most people are trying to do what's right, but most people are also a product of how they were trained, right? And so a lot of businesses are built, again, on selling things. And so what you find is there's different models in the advisory practice. Some are very transactional, where their whole job, everything they do is going to be designed in order to sell you a thing. And you pretty quickly figure out when you're asking questions and they're asking you questions, what it is they're trying to sell you. Some sell insurance, some manage money, some again do planning. Some do a blend of those, right? So it's actually pretty hard because it's hard to know what it is their motivations are. So I would think one of the most important questions is, most important things. One question, understand how they get compensated. Okay, that's probably one of the most important questions you can ask is, how do you get compensated? And, that people will dance around the subject, but what you want is transparency, right? So you want to be able to have clarity on those questions. And you really want somebody, in my opinion, that is looking to understand you. How do I understand you and what makes you tick? In our wealth management firm, we had 3 core principles. And one of them we called mastery. And the idea of mastery was, most people, there's a difference between mastery and expertise. Okay, experts know more and more about less and less. They have a very narrow understanding. So a lot of people in the financial services space are experts in a thing. It could be investment management. They're very good at managing money. Do I pick Home Depot or do I pick Lowe's, right? They're good at that, and that's their specialty. Some are really good at insurance. Some might be good at estate planning, and they're specialists in that space. Mastery is the opposite of that. Mastery is a widening or a broadening of your knowledge to where you have to understand how all the different pieces fit together. And so it's a different style. We used to call it becoming an expert generalist. Right? Which sounds a little oxymoronic, but how do you become an expert generalist? How do you know how all the different pieces move apart? Right. So what we would commit to from the standpoint of mastery, and also alignment was our other one, is I need to know more about you, what keeps you awake at night, and where you want to go, right? What does your ideal life look like 7 years, 10 years, 20 years
Those
from now?
financial goals.
And it's life goals. It's not even financial. It's who do you want to become? And so interesting on that point. I like
that perspective.
Yeah,
absolutely. Because we don't think about that. We're living in our day to day. We're living right now. And we just want to know what's going to get us to the end of the year. What's going to get us from this month to next month, especially, where we live today. But
very true.
We become short focused, and the world's pushing us to be. We have a give it to me now society we live in, right? And that wasn't always the way. I'll tell you a little story about something I learned early on along those lines, and this comes back to kind of the psychology versus the math of financial planning. And what would happen is I'd meet with the family and they'd show me all their financial stuff, and I'd break it down and build giant spreadsheets that showed their investment and their risk and the reward that they were going to get and projected returns and tax implications, and redesign it all, and might show them how they could save hundreds of $1,000s in taxes and reduce risk and get better returns and all this great stuff. And I'd show them this really cool spreadsheet. And I'd say, let's go. Do you want to move forward? And what did they say? I want to think about it. You're like, what's there to think about? I've done the thought for you. I already did the thought. It's arithmetic, and here it is. It's black and white. It's very simple. And they want to think about it. And so I started realizing there's something missing, right? This isn't about math anymore. And so I experimented. Somebody else gave me this advice. I sat down with the family, a big giant flip chart and a Sharpie pen, and I asked them one question. I said, what's important to you in life? What matters most to you? And it got awkward for a minute because, like I said, they're expecting to have a financial conversation. Like, you mean about my finances or about what? No, just life, what's important. And they started talking and started writing down the things that they said were important to them. And we got to the end, we prioritized them. What's first most, what's second most, and why? And when I look back at the list, they had about 7 things on their list. And you know what was not on the list? Sharp ratios and standard deviations of their investment portfolios, the rate on their loans, the balance in their checking accounts, the fees they paid. That was nowhere on the list. What mattered to them was their family, their faith, security, my kids being okay, my health. I want to do something in the community. Those are the things that mattered. And I had this epiphany that said, oh my goodness, your money is your engine to get you that life you want to live. So if we can define, how do you live life where the things that matter most are your first most important priorities, and what are the principles under which you're willing to live to get there? Now the money is simply a puzzle you put together to build the engine to give them that life. And people can get connected to that. right? I view it the same in home ownership. People want to buy a home. Well, it's why. Let's talk about that. Let's see how that fits into your life and lifestyle. And then the money just becomes the puzzle that you put together in order to build and construct the engine to get them to that point.
That is an amazing way to look at things, because ultimately that's what we all want. We want better lives for our family, our friends, and things of that nature. So you really never put it in a way that, you know what, your money is the engine to make all those things happen.
Yeah.
Now, I want to kind of take a few steps back, because you kind of touched on how a financial planner, one of the questions that we should ask is, how are they compensated? But I mean, with me not knowing, or with no one really knowing that much about a financial planner or why we need a financial planner, if a financial planner just so happened to tell us, yeah, I get paid this way, or I get paid that way, let me ask, how exactly does a financial planner get paid?
Good question. So there's multiple models. There's more than one way, and some get paid in lots of ways. And this could become a bigger question, because it also becomes to how they give advice. You've probably heard of a fiduciary, and you have a fiduciary responsibility. Like, that's a whole term that is super interesting to me, because it's almost like there's a legal requirement of, can you legislate or create rules to force morality or ethics, right? Which is a really twisted thing in itself. Like, can you legislate common sense? Can you legislate morality? I don't know. To me, people either have or they don't. So that's an interesting, we won't go down that path just yet. But so the common ways people get paid to sell product. So it could be an insurance product, it could be a mutual fund, could be an annuity, and those would have some type of a commission associated with it, where you buy this thing, I get paid by the company. A lot of them will say, oh, you pay nothing. You do. Of course you do. It's built into the fees and expenses associated with the product you buy. So the products you choose, right, to get you where you want to be financially can have fees, commissions. They will have fees, and some will have commissions attached with them. That could be a way they get compensated. And by the way, nothing wrong with any of these models. There's nothing wrong with how any of these things get paid. It's really a function of you having transparency to it, so you can kind of read, is there a motivation here? You know, if you look at, I study trust a lot. Like, how do you know if you trust somebody? Which, again, whole nother podcast. But the trust thing, one of the biggest things that determine do you or don't you trust somebody is your belief in their self versus outward orientation. Are they more motivated by self or more motivated by what's in your interest? And that's kind of the fiduciary concept. Do you put my interest before your own? So no bad formula. You just want to know it so you can start sniffing out, hey, you're telling me this because you get paid, right? So that's one model. Probably the most common and evolving model is an asset-based model, which is they're going to get paid a percentage of the total assets of yours or everybody's that they manage. So if you have $1 million and they're going to charge you 1%, they're going to make $10,000 a year. The debate there, or the discussion there, is now I'm on your side, because if your wealth increases, I get a raise. If your wealth decreases, I make less money.
So it's beneficial to both parties at that point in time.
The twisted part I always found is, as an advisor, you actually work 10 times harder in the down market than you do the up market. So, there's always and everybody's always mad at you, right? So it's like, it really stinks. So now you're getting paid less, everybody's mad, and you're working twice as hard to maintain and manage risk. But so that's a function. And then the third way would be more through a fee-based type planning. So that would be a scenario where I'm going to give you advice, and I'm going to charge you a fee, flat fee, hourly fee, something along those lines, in exchange for the advice I'm going to give you. And it's no longer attached to the money I manage. And then, of course, you can do combinations. So I can tell you, when we built our firm, we decided to do a blend. So I like the fee-based model. And I like the flat fee and the asset management fee. We always started with a plan in mind, because, again, you say, manage my money for what? Like, what are you trying to accomplish? And if I don't know that, I have no clue what our projected returns and how much risk you're willing to take. The job is more risk management than it is make money. At the end of the day, most of the job is risk management. Most advisors view the world through the lens of risk. How do we not lose money? That's first and foremost. Second, don't lose money. Third, maybe we'll try to make some money. Fourth, maybe we save in taxes, right? And so all of that flows through this thing. So we always had a plan that we designed, where we would design a plan for you, charge a fee for that plan. And the reason we did that is because, A, is probably the most valuable thing we did, but also we didn't have to sell you something at the end of that in order to get paid for the time we just spent. A lot of people will do a plan. They'll say the plan's free, but really
Right.
expectation is you'll bring money over and we'll manage it for you. Again, nothing wrong with that.
Right.
But to me, now I have to sell you something if I'm in that model in order to make up for all the time I just spent with you.
So if I had to simplify it, some people, I can only imagine that you get phone calls all the time from your clients and whatnot to find out if they're making a good decision, or maybe a financial planner will be that person to help. Hey, you know what? I want to send my kid to college. My kid's 8 years old now. And of course, when it's college time, I want to make sure I have enough money to make sure I get them there.
Yep.
So at that point in time, you would come in, take a look at my finances, give me some ideas, give me some advice on where to put my money to make sure I can maximize it so I can send my kid to college. And I imagine that would be the same thing for, retirement, I would imagine.
Yeah, every decision at the end of the day kind of comes down to, I've got an extra dollar, where do I put it? So if you've got an extra dollar, is it going to the college fund? Is it going to the retirement fund? Is it going to insurance to protect your family? Where are we going to throw that extra? Am I paying down my mortgage, right? So all of those become decisions where there's a return and an opportunity cost of that decision. The interesting reality is for a lot of people that are, we talked about the person just out of college. I just got my first job. I'm now making, $60, $80, $100,000 a year, whatever the number is. And I'm used to being broke, and now all of a sudden I'm starting a family and I've got kids and now I want to buy a house. How do I fit that in? Right. Those are all life decisions that have to be made. The principles behind those decisions are pretty much universal. So it's back to the kind of the math of an advisor helping with those. It's hard. Not many advisors have a business model designed to help that person, which is sort of the sad, I think, fault and flaw in the system is if I'm an advisor and I manage money for people, if they don't have assets for me to manage, I'm losing money if I talk to them, right? Which is a big flaw. So at our last firm, we built it was that mastery initiative we talked about a little bit earlier. How do you create a one-to-many type of a plan where I can just provide advice? So good example. We have a family, so they've got kids or grandkids. Hey, my kids or my grandkids, they bought their first house, they had a kid, they're trying to figure out what to do. Can you help? Yes, of course. I learned it was easier for me to sit down, spend an hour with them, get a pen and paper. Here's the next hour, I'm going to give you the next 5 decisions and things you should do. I didn't need to charge for it. It was really just a way to give back to families and said, here's the next 5 things you could do. There's some universal just financial principles that people can follow where you probably don't even need to go to a financial advisor for it. There's great books, there's great resources out there that can help you think through what are some of those decisions that you make. And now there's actually this whole emerging market of financial coaches, which are really people that are more to help you with, I would say, the more behavioral side of money, which to me has an even bigger impact. When I'm working with my kids and teaching them stuff, it's financial behaviors more so than, investment decisions or any of that type of stuff. How do you create good financial behaviors, I think, is the real thing for people to ingrain at younger ages when you're starting to create and accumulate wealth.
Do you feel that, or what's your opinion on renting versus buying, and how, especially coming out of college, like how quickly should someone be looking to do something like that? And just because you were talking about reading and different things that they can do before maybe they come to you as a financial planner or advisor, and maybe what those steps might be as far as,
good question. So I'll give you the universal answer to every question that I've ever been asked in the financial space is it depends, right? I had a client that got me a shirt that said it depends because she was so sick of me telling her that every time she asked the question, right? So, but it really does. And it does come back to, you and every person is unique and different. And what are they trying to accomplish? What is your income? Are you going to stay in this area? Do you think you're going to stay in this area? What's going on with interest rates? Back to I've got an extra dollar. Am I better putting it here or putting it there? Do you have the ability to make a down payment? Does that even matter? Right? So all of those little decisions come into place. My personal opinion, real estate is one of the greatest accumulators you can ever have. Right? The sooner you buy it and never sell it, the better. I'm a big believer in real estate as a wealth creation tool. And you guys are in that space. You know more about it than I do. But I think it is one of the greatest wealth accumulators, better than just about anything else. The stock market's interesting. I've been in that space for over 20 years, and it still freaks me out. Managing, I view the world through the lens of risk, right? Managing risk in public markets is really tricky because it's global now and it's hard to account for that.
It is. And one of the biggest questions I feel we get is, I need to save for 20% down. And until I have that 20% down, then I can't look. I need to rent. Where that's definitely, at least in my opinion, that's a misconception. What's your opinion on that as well when it comes to that?
Yeah, I mean, there's programs now for people to buy homes with less than
Yeah.
20%. I mean, you could say, yeah, the more you put down, the better. Maybe, again, interest rates come into play. That the reality of home buying, good or bad, is most people do it based on cash flow.
True.
People buy a house based on payment, not the value of the home. Right. So what starts happening at some point, I think it's already started, it'll probably actually happen in a few years. Now we'll see, the 50-year mortgage, the 60-year mortgage. Why? Because now my housing prices can stay up and my payments can stay flat and I can now buy more home. Is that good? I don't know. It achieves more people owning homes, but what's it really doing? Well, it's costing them way more to buy those homes. But is it still worth it? Depends on where you live, right?
True.
We're in California. Homes appreciate. They don't appreciate everywhere else. So you have to factor that into the equation. Can I rent this down the road if I were to move and decide I want to live somewhere else? If it's a bad market, can I afford to hold on to the property? That's another piece. Am I in a market that I can rent it? So that little equation is going to come into there. You mentioned books and things.
Yes.
I will tell you, so I've read a ton of them, obviously, tons and tons of books. I just recently reread one, and it has reinforced my favorite one ever, is The Richest Man in Babylon.
Yes.
Old school
I've
book.
read that. It is.
But it is, you want to talk about financial principles and behaviors. It's a great little story. Dude that lives in a village. The guy walks by with a jingle in his purse and he wants a jingle in his purse.
Very easy read.
So he goes on this expedition to figure out, how do I get a jingle in my purse?
Yeah.
And he learns all of these principles that I think to this day are some of the best time-tested principles that will apply to making sound financial decisions as you're creating wealth.
So to bring it all the way back, essentially, it would be wise for a person just starting out to get with a financial planner before purchasing a home, just to get a better idea of what to do to get that home. And that kind of ties into my next question of, do I need a financial planner to budget while I'm in a home? Or do I need a financial planner just to budget my savings or my spending? Are these things that I should have established before buying a home, or are these things I should establish when I'm in the home, or period?
Yeah, I mean, chickens and eggs, right? Most financial advisory firms are designed around investing money. That's the core to most of their businesses. So, it kind of comes back to that. Can you find the right person that can help you with making that decision? An advisor might help you decide, okay, I have to not contribute to my 401k in order to afford the housing payment. Is that a good decision or not? You know what the answer is going to be?
Yes.
It depends. It's always the answer, right? Come on. I
want to say yes.
I teed you up for that, right? So it always
did.
depends, right? And so what they will do, though, is help you think through, here's the different things that are going to be impacted by the decision you make. Most financial decisions you'll make are not black and white. They're not absolute, this is what you should do, not that. They're usually a risk-reward decision. I can do this at the expense of that. I'm willing to tolerate this much risk, and so I will do it. And so it comes down to a good advisor, in my opinion, is going to present you with information, right? Here's the what happens if you go this path. Here's what happens if you go that path. And the way I know this is I've been down both of these paths lots of times with lots of families. I used to call it the hidden waterfall story. Okay, so hidden waterfall story is we're going down a river and I'm your river guide. We're in this river and it's rapids and we're going down, but I've been down it a bunch of times because I'm the guide, right, with lots of people. And I happen to know around the next bend is a giant waterfall. So the question is, do you want me to let you know when there's a waterfall coming? And most people would say, well, yes, of course,
Yes.
right? So
Yeah.
my job is to let you know there's a waterfall around the bend. You're in control of deciding if you want to get out of the boat. I'm hiking down. You can get out and hike down with me, or you're welcome to go over the waterfall. And a lot of people do. A lot of people choose to go over the waterfall. So in that case, I'm getting down, I get out my phone, I'll take a video of you going over it, I'll throw it on YouTube, get some followers, it'll be fun, and you will experience that hidden waterfall. And so a good advisor is able to show you where those hidden waterfalls might be. That decision might sound smart now, but there's a waterfall around the next bend that I can advise you to avoid. And we're gonna hike down here. And that could be the decision to, I don't wanna buy the home because I think I need to wait till I have 20%. And Why would you do that? You're going to wake up in 2 years and that home's going to have appreciated in this market, and you're going to miss out on an opportunity to have created equity or wealth for yourself. So that could be, and it could be the opposite. It could be based on what's going on right now. They could say, you know what? Now is not the time. I think you should rent for another 6 months, 12 months. And let's look in the next market where you're going to or where you think you want to move.
Right.
And let's plan for that, because you might put a bunch of money down and you're planning to move the next 1 to 2 years. If we see something soften, you might be out that down payment. Yeah. And so all of those come back to having somebody ultimately that can ask you good questions, who can ask you the right questions to help you think through the options so that you can make an informed decision and give you the power and the confidence in the decisions you're making. We used to tell people our real job is to give you peace of mind, to know that you're going to be okay with the decisions you're making, and we got your back, and confidence that you have the right people around you to make the most informed decisions that you can.
I'm gonna be honest, that whole waterfall thing terrified me.
It's supposed to.
People going over the waterfall,
it's bad.
It's scary.
And I loved the analogy because I was like, I'm going down the waterfall. Now, I don't want of course, the repercussions of that. But I do want to go down the waterfall.
You learn a lot from going down waterfalls, right? You know, a little adventure there.
That is true.
Depending on the size and scope and the rocks
Maybe when
below.
I was really young, but maybe not later on. But yeah.
So one of the biggest things, especially in our field with dealing with homes and whatnot, the biggest hurdle that most buyers tend to have to get around is their credit scores. With that being said, can a financial planner help you get your credit scores up or keep your credit scores up?
They can. Most, again, kind of aren't in that business. It's kind of like budgeting. And the reality is most advisors don't help with budgeting. They'll take your information and create projections, but it's really not budgeting. I don't like doing budgeting. I've never enjoyed it. I don't like it myself. My father was a great budgeter. He tracked everything, still does, and that's amazing to me. I had a hard time with it. I just don't enjoy it. And so to me, it's more principle-based decision-making. Credit score is kind of similar. There are key things to do to create or improve your credit score. And so then it's kind of come back to the financial principles that you need to follow. Now, a good advisor should be able to look and say, okay, your score is this. If you tweak these 3 or 4 things, you should be able to improve it. I would say, this is not database, this is a guess. I would be willing to bet people in the lending industry probably have a tighter grasp on impact on credit than a lot of financial advisors, just because they don't get as involved in lending. So a good financial advisor, back to that notion of mastery, right. I know more about you than anybody else in any room walk into, and I need to be the second smartest person in the room in every other subject. But I also need the first part, I need experts around me. So an estate planning attorney, an insurance person. If I know more than your estate planning attorney, you probably have the wrong estate planning attorney. But I know a lot about it. And lending. As an advisor, your advisor should have a great lender that they have a close relationship with. And if they don't, they should find one. We spent years trying to find great lenders that we had confidence in that would treat our clients with the same level of intellect and compassion that we would. And so finding those people becomes critical. So if it were me, I'd reach out to a lending partner and say, hey, I've got this client, they want to buy. I think that, there might be some issues here. What can we do to work together to help them? And you might have the answer for what needs to be done. I might be able to help guide them through restructuring some of their finances in order to get there. So maybe we're reallocating, we're paying down debt a little more quickly than we're putting money into the college plan. So there might be some little things like that we start to tweak because that goal has now become a priority over the other goals that we were previously planning. Mm-hmm. So in that environment, it becomes collaborative, right? Can you get the team of people around to help you in order to, because finance is complicated. There are a lot of things to know about every nuance in the financial industry, right? There are so many things. And so having a few smart people around you starts really making a big difference. And if they communicate, even better. So you're not getting ping-ponged around a bunch of different advice from bunch of different people.
Right.
And just for the record, we know a good lender.
We do.
And
I was thinking, just based on what you were talking about, when it comes to maybe later in the years, as you've guided them through paying down their mortgage or moving that dollar from here to there. And then once they're, let's say, at that retirement age, the possibility of maybe using that asset as maybe income. So a reverse mortgage, I do reverse mortgages as we do, but that's one of the topics that a lot of people don't know about, or there are some misconceptions with that. And so what's your opinion about a reverse mortgage, and how, as a financial advisor, would that
good question. I'll answer that differently than I would have 7 or 8 years ago.
Yes.
7 or 8 years ago, you say that, I would have thrown up in my mouth and told you, go away. It takes advantage of people. Kids lose house and all these terrible things.
I was waiting for you to say it depends.
It does depend, but I was challenged years ago to do the math on a reverse mortgage. Some friends of mine were in the space. They were trying to get me to help out, and I said, no, it's a scam.
Yeah.
They just challenged me, do the math.
Yeah.
I did the math. Blown away. Absolutely blew my mind as to what the possibilities are. One of the things in planning you're always trying to achieve is the balance between certainty and flexibility.
Yeah.
Certainty and flexibility. And most financial products and solutions have one at the expense of the other. I can get certainty, but it's going to cost me flexibility. I can get flexibility, but it costs me certainty. A reverse mortgage, in my opinion, is one of the most misunderstood, underutilized tools in retirement planning. Forget lending, in retirement planning today. Because people say, oh, it's just a loan. It is sort of a loan, but it's actually a financial instrument.
Yep.
Used correctly, once you understand the power of the flexibility and certainty you get with it, you essentially have an asset that you can't access, right? So I always ask people, what's the economic return of the equity in your home? What's the economic return of equity?
Zero,
right? It's zero. You know, your home will go up and down.
Yeah.
Your real estate, but if you owe 90% or owe them free and clear, does it change the real estate valuation? Nope, it doesn't. So the real estate has value, but the equity itself has zero economic value. The only way to get value out of that real estate is to find a way to access that equity. Well, how do you access equity? You can sell your home. Cool, that's one way. Sell it, move to a smaller house, maybe get some. That's a way. Most people don't want to do that. Cash out refi. What happens to your payment?
Right.
Going up, right, in most cases, because you're having to get cash out, so you have a bigger mortgage. Unless rates drop by a ton, you'll probably have a higher payment. You're in retirement. Do you want a higher payment? Nope, you don't. Home equity line of credit, not a bad way, inexpensive. Still got an interest-only payment. What happens after 10 years?
Yep.
Now you fully amortize for 15. Your payment jacks by 60%.
Right.
You don't want that in retirement. Reverse mortgage is the only thing that gives you that flexibility where I now have options. And most people look at these as I don't make a payment or I get money from it.
Right.
My personal opinion, the way I've used this more often than not is as, again, a risk management tool. What it creates for me is optionality. I have the option of whether or not to make a principal and interest payment. As most people know, you still pay taxes and insurance. Don't mess that up because that's bad, right? So that's a lot of the bad things you've heard is somebody forgot to mention pay your taxes and they didn't, and that's bad, right? So pay your taxes and insurance, but the principal and interest payment becomes flexible. And now I have the choice. And we could get into whole line of credit growth. That's a whole nother podcast, which will blow people's minds. But the line of credit growth is super interesting. So I've modeled more of these for people in early retirement years in their mid 60s, put it in place, but continue to make payments. So they keep making payments on their existing mortgage, could be interest only to keep it flat so it's not accruing, or they could actually be paying it down because at the same time, if you structure this as a revolving line of credit, money you can draw from, pay it back, draw from, paying out with absolute flexibility, that credit line's growing over time. So by the time you're in your late 60s and 70s, you now have this incredible access to liquidity should you need it, access to cash should you need it in the form of this equity line. And the main way I've also seen it used is one of the biggest financial risks that people will face in retirement is there's two. One is, market volatility, but really the big one is some type of in-home care health need.
Yes.
It's getting so expensive.
Okay, Ryan. So I'm gonna play a bit of devil's advocate because of course we have the rebels at home that are looking at this right now and they're saying, you know what, my parents taught me how to save. Why do I need to hire a financial advisor or a financial planner? Why?
Experience, someone that's been over the waterfall and knows where it is, someone you can lean on that can give you good counsel, someone that can ask you questions, someone that can give you insights and access to market opportunities. It does depend on where you are in your wealth accumulation journey to determine who's the right fit for you. But ultimately, those become the things. How do you get a person on your side that can give you insights? Because you can't know everything there is to know. right? You will have questions and you need somebody you can trust. Again, another conversation to have. Trust. Are they competent? Are they reliable? Do you connect with them? Do they put your interest before their own? And if those things align and this person is of credible incompetence, that's a tremendous resource to have access to in order to be a sounding board in the major life decisions that you're going to make.
So let me ask this. Let's say I wanted to buy a house within a year from now. What advice would you give me in order to do so?
Position your assets to do so, right? So get a good lender. You're probably going to want, at some point, you'll want a real estate person. I personally think the lender is the most critical person there. You heard it here. Because you need to position yourself to get qualified for a loan, right? So what does that look like? If you've got a year to do it, are there things you want to clean up with your credit? Do you have the ability to put money down? What loan programs are available to you? Are you a veteran, right? There's so many programs out there that most people don't know. Kind of like a financial advisor, having a person on your team that has knowledge of an industry that you can't possibly learn enough about in the amount of time you have to figure it out. A lender is the same thing. They have intimate knowledge of an industry that I don't have time to go figure out.
Yeah.
And so I need a lender that can look at my situation and know, based on where I am financially, based on the type of property I want to buy, what is the best program available to me. And now I can work either with my advisor or on my own to figure out, how do I position my assets to be able to purchase that home, and what does that look like? And you got, where am I going to be 3, 5, 7 years? Do I have kids? Do I not have kids? Do I need a place with schools? Not schools. Do I have, now I start open questions of, now I probably need to look into some estate planning, because now I'm in California. If my assets add up to more than $100,000 or so, something happens to me, I'm in court, or my family's in court. I have kids. I want to make sure they're going to be okay. Do I need life insurance? It starts triggering all these little questions. So to simply buy a house, get a lender, position assets. The things that come along with it, have somebody you can trust on the financial side that can bounce ideas and be a sounding board for you. Sometimes harder than it sounds to find those people, but when you do, keep them close, pay them well, because you'll want them in your life, because they will have an impact on the decisions that you make over time.
Well, and you are a financial advisor for life. That is what your purpose is to take us from, at least as I teach my son as he's coming out of high school, as I said earlier, I want him to have that team around him that takes him from this particular time in his life all the way through. So
absolutely. And that team can change over time.
It can.
Who's good at different things, changes based on where you are in life. Most of us don't need an attorney today, but at some point you start a business. What's that going to look like? That's going to change the team of advisors that you have. Right. And so really the question, and you asked this earlier, Carlton, which was, how do you know who to go with, who to choose? That's a whole episode, right? And I've taught this whole concept of, how do you build, identify, accelerate trust? How do I know if I can trust the person? And trust, sadly, is more perception than reality. I used to joke with people about, choose an advisor, choose an attorney, choose anybody. Do you want somebody that's really successful or somebody that's really good? Because they aren't always the same thing. I've met a lot of very successful professionals that I would not trust giving advice to my family. I found a lot of ones that aren't that successful, but they're financially, as we would think of success, but they are incredibly skilled and talented at their craft.
Yeah.
Right. And so those people I would trust. So but you also want them to be in business 3, 5, 10 years from now, right?
Of course.
So how do you find them, help them elevate their business while using them, leveraging their counsel for your own personal growth and wealth creation?
Well, Ryan, I'm gonna be honest, I don't know where you've been all my life. I've learned more in this few minutes, and I need to go home and I think I need to fire my financial advisor.
Oh, no, don't do that. I'll get in trouble.
But look, everyone, if you didn't know, a financial advisor, a financial planner is the person that you need. Once again, Ryan, thank you so much for coming by and sharing your knowledge with us. Once again, thank you everyone for joining us with Homeschool. This has truly been a pleasure. I'm Carlton Puckett.
I'm Mary D. Bryant.
And this is Ryan Ponsford. We appreciate him for coming out, and hopefully you learned something today.
Thank you so much for joining us. Yes.